A conventional loan and a DSCR loan can both get you the keys, but choosing the wrong structure can limit how far you can grow and scale efficiently. Really important to understand the differences between the two. Here's where conventional loans typically start breaking down for real estate investors. With a conventional loan, you can do as low as a 15% down payment, but the biggest hassle is you're going to have to qualify off of your personal income. So the lender's going to do a job verification, they're going to check your debt to income ratio, they're going to ask for all your pay stubs, tax returns, or W-2s over the past 2 years to make sure that you do qualify. So one of the more common reasons that you might switch and pivot to a DSCR after tapping out with conventional is either maybe you already hit the 10 property limit that conventional has, or maybe you're just having a tougher time qualify based off the debt to income ratio. So the DTI is always the number one driver that really limits investors to scale with conventional, because of course with DSCR, there's not going to be any cap with how many properties you can actually own. Maybe you're self-employed, you have a complex tax situation, you have a lot of write-offs, you know that your CPA is going to be very involved with getting that loan. So you might just want to avoid that process entirely, less paperwork, less stress, not get caught up with all the documentation and just pivot to a DSCR for that reason only. Most investors don't really leave conventional loans, they just outgrow them with their profile, right? All that documentation that comes with it, the hassle, the limitations of conventional, DSCR is not going to have any of that. DSCR underwriting is still strict, but the lender's only focused on the actual property itself and not you. So there's not going to be any consideration at all towards your personal income, your personal finances in regards to income, employment, DTI. The lender's only looking at the rental income that the property would perform as, right? So the lender ideally wants a 1 DSCR ratio. This is where the rents completely covers the full mortgage payment after taxes, insurance, and if there's an HOA fee. So the lender will look at the appraiser's 1007 rent schedule if the property is not rented, or they will make consideration to the actual documented lease, typically on a long-term basis, if the property already is a rental property. So DSCR has become really popular because there's no limitation with how many properties you can finance. You're not going to have that 10 cap that a conventional loan would have for buying rental properties. So when it comes to actually expanding your portfolio, there's no better option than a DSCR loan. Because lenders view these loans as a business purpose loan, typically most lenders will actually allow you to vest the actual loan itself under the LLC, and therefore they'll let you put the loan under an LLC at the time of closing. Can be a huge benefit if you don't want that loan on your personal credit report, right? So that loan's not going to show on your personal credit because that lender views it as a business purpose loan. So closing under an LLC could give you extra liability protection. Both conventional and DSCR do have a lot of overlap and are pretty similar in a lot of areas. A DSCR loan, if you have strong rental income, have a 1 DSCR ratio, which most properties are not going to have. You can go as low as a 15% down payment. With conventional, it's the same thing, 15% down payment. There is going to be a PMI with conventional. There would be no PMI with a DSCR loan. In terms of fees and costs, typically interest rates are almost always more attractive for conventional because the lender has the luxury of you actually qualifying off of the personal income. So in terms of cost, fees, conventional takes the cake pretty much every single time, except for the 15% down that doesn't have that PMI. I think it's a very underrated little hack and tip for a 15% down, and I love that option for a lot of my investors. So one other thing I wanted to cover in terms of fees, a DSCR loan typically does have a prepayment penalty, right? So a prepayment penalty is the cost of buying out of that loan before either the 1 year, the 3 years, or 5, whatever the length of that prepayment penalty is. You have to pay a pretty significant fine, so to speak, right, to buy out of that loan. So some states do not allow for prepayment penalties. So with that, you'd essentially be buying out of that prepayment penalty at the time of closing. With conventional or DSCR, every lender is going to want to see some sort of reserve. So one reserve is 1 month worth of mortgage payments you have in the bank, retirement account, money set away. With conventional, that reserve requirement is going to be the same for all lenders, and it's going to be tied to the amount of properties that you actually already own. The unpaid balances of all those properties will dictate all the reserves you need. With DSCR, it's typically a fixed 3 to 6 months worth that you need for a DSCR purchase. With conventional, you're never allowed to use any kind of gift funds to come up with that down payment. For DSCR, you can actually use gift funds to purchase and come up with all of the down payment requirement. Investors don't switch from conventional to DSCR because it's easier. They really switch because conventional stops letting them grow, and DSCR is that resolution and answer to all the headaches they have for conventional. So it can be a great option. Conventional can be a better option too for newer investors. I think hopefully after watching this video, I brought some more clarity to your situation, and now you know which option might make more sense for you. My name is Austin Clarence. I'm your DSCR loan officer and active investor. Any questions, please shoot me a comment, drop me a message.